we have seen a disconnect between the headline GDP numbers, which are strong in Kenya. You're seeing 5 to 6% GDP growth, and yet when you go to the ground, economic performance is not as strong. And this has been highlighted by the low consumer demand. We've seen consumer companies saying that there's some consumer weakness in the market. It's also been highlighted by poor corporate earnings, which we've seen on our listed market, and the failure for KRA to meet its targets from revenue collection, tax collection. Businesses use credit in terms of working capital to embark on projects to expand their businesses. And so we think credit has an important role to play in economy. We see a lot of SMEs using credit, and we think that those are some of the areas where we are seeing some weakness. As we look at the private sector credit growth slowdown in Kenya, we want to compare it to Uganda, and this is mostly because of some of the similarities we see in these economies. When we look at monetary policy effects, Uganda also has a free market economy where they use monetary policy to target inflation, and they're able to flexibly adjust the central bank rate. We've seen them reducing their central bank rate from December 2015. So we'd like to see what kind of an impact that has on their private sector credit growth. We also look at fiscal policy, where Uganda is doing some of the same things that we've seen Kenya doing. They've embarked on fiscal expansion. They're increasing the investments into infrastructure, energy, roads. So those are some of the things that we are also seeing in Kenya, and we'd like to see whether this has had an impact on how much credit the private sector can access. For Uganda, we've also seen the same thing that we're seeing in Kenya for deteriorating asset qualities, spike in NPLs, increasing provisions for the banks, and we'd also like to see whether that has been as adverse in Uganda as it has been in Kenya, and what that means for credit growth. The private sector needs to improve for us to actually achieve that 6.1% expected growth. And one of the ways that the private sector can actually improve in performance or expand is actually using leverage, and that's using credit. The banks need to increase loans to the private sector for us to see the private sector contributing to the headline GDP numbers, as we have seen the government investments contributing.
Some of the factors which have affected asset quality include the economic downturn in both Kenya and Uganda. We've had a period of good top-line GDP growth. However, it's not being felt on the bottom level of personal spending, or also in terms of business performance. Something else that has also affected asset quality is the stricter regulatory standards when it comes to classification of non-performing loans. So historically, we were in a regime where banks had the freedom to reclassify non-performing loans as many times as they possibly could. But now, regulation is more strict, and after a loan has not been serviced for about 90 days, it automatically becomes an unperforming loan.
What we have seen is many companies slow down on executing investments and spending on capex because of what is happening in the political environment. And there's been a slowdown in deployment of capex because obviously when you deploy investments, you expect a return. And for many businesses, the return is then going to come through off the back of the revenues that they can be able to generate. And obviously revenues are coming through from customers. And in line with the slowdown in economic growth, we've obviously seen disposable income from the point of view of customers slow down because really nobody is spending. So for many businesses, political uncertainty means less investment, less capital expenditure, and less growth. Again, you've seen that from the point of view of banks, they are also now reluctant to lend into this same private sector because again of this, because of the political uncertainty and the risk that we're certainly seeing. So the banks won't lend, and the companies are also not keen to spend. So really that is the impact that we've seen on the private sector. And I can tell you that for many businesses in construction, trade, agriculture, IT, manufacturing, tourism, they're not going through easy times because of this issue of political risk. What is the framework that really is being considered as we then move away from interest rate capping? To our best understanding, there is no alternative framework being proposed. The alternative framework is, in fact, to go back to the previous regime, which is really a market-based framework or policy, and as far as determination of interest rates are concerned. So it's really the adoption of market-based monetary policy rules that we are talking about here, where banks are then free to price not just for credit risk, but for every other risk that they typically price into these loans, around whether it is liquidity risk, and so on and so forth.